Understanding investment funds, mutual funds, index funds, and ETFs. Welcome to Wealth Echelon, your go-to destination for expert insights on finance, stocks, and ETFs. Our mission is to empower you with the knowledge and strategies needed to navigate the financial markets with confidence. Whether you're a beginner looking to build a strong investment portfolio or an experienced investor seeking market trends and analysis, we've got you covered. Join us as we break down complex financial concepts, explore market opportunities, and help you climb the ladder to financial success. Subscribe now and take control of your wealth journey. Investing in the stock market can be overwhelming, especially when trying to maximize returns while minimizing risks. This comprehensive guide explores three major investment options: mutual funds, index funds, and exchange-traded funds, ETFs. It breaks down how they work, their advantages, drawbacks, and key differences to help you make informed financial decisions. Introduction to investment funds. Index funds, mutual funds, and ETFs are three different ways that you can invest your money in the stock market. When it comes to investing, your goal is to maximize your returns, how much money you make, while also reducing the risk of how much money you lose. For example, say you do some research and decide that the best investment of all time would be to buy Apple stock. You put all your money into Apple, and for the first few years, things go well. The company continues to grow, and your investment increases in value. However, one day Apple releases the new iPhone 20, and customers don't like it. This single product failure changes the business landscape, causing customers to turn away, reducing Apple's sales, and ultimately leading to a decline in its stock price. If you have all your money invested in just Apple, your entire investment will suffer a significant loss. This demonstrates the importance of diversification, investing in multiple companies rather than just one. But diversifying takes time, effort, and research. You would have to analyze different companies, figure out which ones to invest in, and decide how to allocate your money for the best returns while minimizing risk. Interestingly, studies have shown that even professionals struggle with stock picking. In fact, some research suggests that a blindfolded monkey throwing darts at a list of companies could perform just as well as expert investors when selecting stocks. Because stock picking is extremely difficult, and because you want your money to grow over time while reducing risk, there is a better option: investment funds. Before diving into the differences between mutual funds, index funds, and ETFs, it is crucial to understand the concept of investment funds themselves. What are investment funds? Investment funds are a collection of multiple companies grouped into one investment. This makes it significantly easier to invest in a wide range of stocks without having to purchase each one individually. Instead of manually diversifying by buying separate stocks, an investment fund does this for you by offering exposure to many companies within a single investment. This method significantly reduces the risk of losing money because even if one company within the fund underperforms, others may perform well, balancing out your overall return. Additionally, some investment funds have historically demonstrated strong long-term growth, allowing investors to build significant wealth over time. Although all three types, mutual funds, index funds, and ETFs, operate under this concept, there are critical differences between them. Failing to understand these differences could cost you in terms of fees, performance, and investment strategy. Mutual funds. Actively managed investment funds. Mutual funds were the first type of investment fund created. They are also known as actively managed funds, meaning that professional fund managers actively make decisions on which investments should be included in the fund. For example, imagine a mutual fund containing 5 major stocks: Apple, Microsoft, Amazon, Tesla, and Google. While most mutual funds contain significantly more than 5 stocks, this simplified example helps illustrate how they work. Because mutual funds are actively managed, a professional money manager is responsible for selecting the best stocks to include, aiming to achieve high returns while reducing risk. If the fund manager decides that Google is no longer a good investment, they can remove it from the fund and replace it with a different company, such as Johnson & Johnson. The goal of actively managed mutual funds is to outperform the stock market, meaning that fund managers try to select stocks that will yield higher returns than the overall market. However, actively managing investments requires significant research and expertise, which means that these funds come with higher costs. On average, mutual funds charge an annual fee of around 2% of your total investment. If you invest $10,000 into a mutual fund, you will pay approximately $200 in fees in the first year alone. As your investment grows, the fee amount increases as well. One major downside of mutual funds is that even if the fund loses money, investors are still required to pay the management fee. Research by the S&P Dow Jones Indices, a leading provider of financial data, has shown that 90% of actively managed funds underperform the overall stock market. As legendary investor Ray Dalio has stated, trying to time the stock market is harder than competing in the Olympics. While some fund managers are exceptionally skilled, gaining access to top-tier funds requires significant capital. The New York Times has reported that Dalio's hedge fund requires clients to have at least $7.5 billion in assets to participate, with investors paying annual fees ranging from $500,000 to $4 million. For the average investor, mutual funds may not be the most cost-effective option due to high fees and the low likelihood of consistently outperforming the market. Index funds, passive investment with lower costs. To address the high fees associated with mutual funds, Jack Bogle, the founder of Vanguard, introduced the index fund in 1975. Index funds are passively managed funds, meaning they are not controlled by human fund managers, but instead follow a computer algorithm designed to track a specific market index. An index is simply a list of securities, such as stocks or bonds, that represent the performance of a particular market. A well-known example is the S&P 500, which tracks 500 of the top publicly traded companies in the U.S. Unlike mutual funds, index funds have significantly lower costs. For example, the Fidelity 500 Index Fund, which tracks the S&P 500, has an expense ratio of just 0.015%, meaning that a $100,000 investment would cost only $15 per year. In contrast, a mutual fund with a 2% fee would charge $2,000 annually for the same investment. One important thing to note is that index funds, like mutual funds, can only be traded once per day after the market closes. ETFs, the flexibility of stocks with the diversification of funds. Exchange-traded funds, ETFs, were introduced in the 1990s as an alternative to mutual funds and index funds. ETFs offer the diversification of an index fund while allowing investors to trade them like individual stocks throughout the day. Unlike mutual funds and index funds, which update their price once per day, ETFs have real-time price fluctuations, making them a more flexible investment option. The cost differences between ETFs and index funds are minimal. For example, Vanguard's S&P 500 ETF, VOO, has an expense ratio of 0.03%, while the Vanguard 500 Index Fund has an expense ratio of 0.04%. Which one should you choose? Each investment fund type has its pros and cons. Mutual funds offer active management but come with high fees. Index funds provide passive management with lower fees and long-term growth potential. ETFs offer real-time trading flexibility while maintaining low costs. A solid investment strategy could involve allocating part of your income to index funds for long-term growth while using ETFs for liquidity and flexibility. If you believe in the continued growth of the U.S. economy, investing in an S&P 500 index fund or ETF could be an excellent choice. Investing wisely requires understanding your options. While some mutual funds may outperform the market, the high fees and uncertainty make index funds and ETFs more attractive for most investors. Whatever you choose, the key is to start investing as soon as possible to take advantage of long-term market growth. Let me know if you have any questions, and don't forget to like, subscribe, and comment below. Blast off.